The best investment opportunity that no one is talking about. This is a video that I don't do very often because it's very hard to find those great opportunities, longer term investment that have massive upside, that not a lot of people are talking about them. Normally, the market is pretty smart and it tends to catch those trends very early. But sometimes it's not the case, and you could get in way before Wall Street and way before most investors wake up to this trend. And that's what I try to focus on in this video. The 4 months ago or 5 months ago, I did the same one, best investment opportunity. It only got 5,000 views, which I wasn't surprised because normally investors and people on YouTube, they want something that's exciting. They want an exciting stories, the next whatever, something that goes to bars, or something about AI. It's not much about boring industries with a lot of upside. It's more about which one has the most exciting story, especially right now in this crazy market. But it was mainly about the infrastructure spending in Canada that not a lot of people are paying attention to. And I talked about the Canadian construction stocks, comparing them to US stocks. And I talked about Bird Construction, which is up 40% from this video. It's up 30% on the month, but it's up 40% from this video, 70% from my cost basis in March, and it's up 100% year to date, and it's still trading at 12 times earnings. So I would highly encourage you to check out this stock again. It might be some value left, even though it's up 100% year to date. But I have another one with a different kind of trend that also has a lot of upside, and it's just starting to play out right now. The market is starting to wake up to this trend. And I talked about it before on YouTube, but I'm going to talk about it again because the stock has gone up a little bit, but I believe it's just starting to play out. And this is an amazing time to be looking into this industry and trying to invest into those stocks while everyone is distracted by AI. There's this industry that's coming to life, and not a lot of people are paying attention to it. Okay. And whenever I'm looking at such trends, I call them mega trends, which is mainly longer term trends. And it gives those stocks massive tailwinds, not just for massive earnings growth, but also for a massive multiple expansion. And this is what happened to the AI stock. Once Wall Street woke up to the mega trend of AI and innovation and automation, you see what happened to Palantir, what happened to Nvidia, what happened to all the AI stocks. Same thing with the EV stocks in 2021. You just woke up and they piled into them. Same thing right now with US infrastructure stocks. Just look at Caterpillar, look at United Rentals. They're trading at crazy high multiples. Even concrete companies, they're trading at 25 times earnings in the United States. It's absolutely, absolutely insane. And there's this trend that not a lot of people are talking about, and it's mainly related to deglobalization. And I'm not trying to say that countries are never going to trade with each other again or something crazy. But there's this trend that started, I would say, in 2022 after the war in Ukraine, and a lot of the supply chain stuff happened, even from COVID. Whenever the supply chain got disrupted, a lot of countries have been investing more into domestic production, into national security concerns related to energy, infrastructure, critical minerals, and many different things. And I've invested in a lot of that stuff in my own portfolio in terms of deglobalization. But with deglobalization, you have normally allied countries that come more together, meaning the United States and Europe and a few other countries. This is what happens. And an interesting thing that happened in Europe after, you could say, 2021 or before 2022, before the war in Ukraine started, most of their energy stuff was coming from Russia. And after the energy stuff happened in 2022, it's been coming down. And they've been trying to diversify away from Russia. And the share from the United States has been growing. And it will likely continue to grow much more in the future. And this is why I talked about this investment before, that I'm going to talk about again. And it's just starting to play out. And I think it's only getting started. And very recently, you have the EU leader, I believe she's called the European Union leader or whatever, and she was saying that they could buy more American gas. And this is what she said: we still get a lot of our LNG from Russia, and why not replace it by American LNG, which is cheaper for us and it brings down our energy prices. So it's a win-win for both parties, and it will help EU avoid potential tariffs that the new administration could put on the EU. And it would be a win-win for the United States, win-win for the EU. And there's a lot of stocks that could benefit from them. And then now it's just starting to play out. I did not invest in those stocks predicting that Trump is going to win and this is what's going to happen. But I said it could be a tailwind, a potential tailwind, if we have a change in administration. And it's just starting to play out. It's only getting started. The market is just starting to catch up. And one of the best stocks to bet on that stuff is a company called LNG actually, which is Cheniere Energy. As you can see, it's just starting to take off. The market is starting to wake up. And I started talking about this stock on YouTube around $164, $165. And I made a 15-minute video explaining the thesis, but people didn't pay attention. They just put in the comment, yeah, but it's up 5% from 52-week low. I mean, it's insane how emotional people are, how everyone focuses on the price, no one focuses on the value. So if you just imagine Apple and Google and all those stocks, if you skipped them just because they were up or just because they were trading at 52-week high. In the market, you have to learn to not pay much attention to the price and focus a little bit more on the value. And even though it's now, I'm going to give you this whole video, I'm going to give you the thesis, a lot of people are still going to say, yeah, but it's trading at 52-week high. But that's how the market is. And it's not easy to ignore the chart and focus on the thesis, focus on long-term fundamentals. But that's what I'm going to do in this video. And I'm going to tell you why I own this company, I still own it, and why I even want to buy more, and why it's such an amazing investment. And Cheniere Energy has the largest liquefaction facility in the United States, and it has the second largest in the world. I believe 8% of total gas in the United States is processed through their two facilities, with Sabine Pass and Corpus Christi. Is the largest in the United States, second largest in the world. They work with many well-known companies, like Royal Dutch Shell and just so many, Occidental and Chevron, and so many different companies that you likely know. Petrobras, they work with all of them, and they ship and they liquefy this natural gas, and they ship it all over the world, mainly to Europe. Their largest markets are Europe and Asia, but they also ship to Latin America and a few other places. But the largest one has been Europe and Asia for the company. Now, I know what you're thinking. Whenever I tell you natural gas, you get scared because you look at other stock. I'm like, man, natural gas is so volatile. Look at the chart. It just goes up and it goes down. A lot of those companies went to zero. Natural gas stocks is a terrible investment. No one likes natural gas. But you're wrong on this one, because this is not your traditional natural gas investment that their free cash flow goes up and down based on natural gas prices. It does affect them a little bit, but it's very little effect on it, because this is, I'm going to show you something which whenever I first wanted to buy the stock, I did not understand the company very well. So I talked with the investor relations page, and this is a screenshot of the email they sent me. And they pretty much told me that they do collect some kind of a fixed fee, which they call a lifting margin. And they collect a liquefaction fee to liquefy the gas. And their contracts, they are pretty much locked in with a weighted average duration of 17 years. So they're going to collect this fixed fee for 17 years. And if Henry Hub or natural gas does go up, let's say $1, it affects their free cash flow by $300 million. Every dollar above 250 affects them by $300 million, but nothing beyond that. And they have very little exposure to the commodity itself, because it's more of an infrastructure story, liquefy it and ship it, other than just, getting the gas and all that stuff. And this is what he pretty much told me. We view Cheniere Energy as a long-term contracted infrastructure story with minimal commodity exposure. And you can see it was one of their recent contracts with a very, you could say, popular company. They agreed to purchase 500,000 tons per annum for 20 years. And this is from a facility that hasn't even built yet. They're trying to expand this facility. It hasn't built yet. Yet Cheniere Energy signed a 20-year contract with the company with a purchase price indexed to Henry Hub plus a fixed liquefaction fee, and it doesn't even begin before the early 2030s. So, this is how powerful this company is, and this is how valuable U.S. natural gas is for them to be able to sign such contracts on a facility that hasn't even been built yet, and it won't even commence before early 2030s. This is amazing, amazing stuff for the company, and it doesn't have as much commodity exposure as you believe. And the company has something called the 2020 vision plan for capital allocation, meaning they want to put in $20 billion from now till 2027. They want to deploy $20 billion in terms of share repurchases and dividends and paying down some debt. And they want to get to $20 per share of what they call DCF, or distributable cash flow, for the company. And you can see it from the dividend. The dividend, they expect to grow at 10% per year, and it's going to be around a 20% annual later for decade in terms of a payout ratio. And they've been increasing it. And this is good for dividend investors that like growth. It's not the highest yield ever, but they're going to grow at 10% per year. The company has been buying back a lot of stock, and they bought back a lot this just previous quarter. They already bought 10% year to date, and they expect to buy another 15% of the market cap by 2027 to get their total shares outstanding to 200 million shares. Amazing return of value to shareholders. I love this company very much, amazing stuff. And they want to get to 20 DCF per share, not just by buying back a lot of stock, but with them finishing the expansion of their facilities. They still have stage 3, which is getting, I believe, 58% completion. It's going fast, ahead of schedule. You could look at the recent presentation. But then they have another expansion, which could take it up to $20 to $22 distributable cash flow per share by mid-2027. And this is how they expect to get there. Last earnings report was absolutely stunning for the company. Everything was much better than expected, and they raised distributable cash flow. It was from 3.1 to 3.5. Now it's 3.4 to 3.7. So it's much, much better than expected. And so far, 2025 shipments will likely be more than the 2024 shipments. And I would expect 3.4, 3.7 is likely going to be much, much higher next year in 2025. Okay, and this is how I'm gonna value the stock. It's not easy to value, but this is how I look at it. All right, now if you look at the 3.7 billion, which is the higher end of their guidance, using this 3.7 billion, the current market cap is 46 billion. And I'm just gonna remind you that next year is likely looking much, much better than this year. But this is the guidance for this year so far. It's likely gonna be around 3.7 billion. Okay, now 3.7 billion out of 46 billion, this is around an 8% free cash flow yield. So the company, even though the stock is up so much, is still trading at an 8% free cash flow yield. I bought it at 8% free cash flow yield over here, and it's up so much on my cost basis, and it's still trading at an 8% free cash flow yield. And this is for now. Maybe the worst case, you get 6% on 3.4. So between 6 to 8%. But I would like to use a higher number on the best case scenario, which would be right now at an 8% free cash flow yield. Now, the most exciting part is if they can hit the 20 DCF per share by 2027 after they finish their expansion plans. And I believe they will hit 20 per share because this management has been on point. They always beat guidance. They were always conservative. I really have I don't have a reason to doubt them pretty much. So I would expect them to hit the 20 DCF per share by 2027. Okay, now if they hit 20 DCF per share by 2027 and it trades around 20 times free cash flow, which is not expensive at all, that would be $400 per share, or around a 2x in 2.5 years, 3 years by 2027. This is massive, massive upside on the stock. If it trades at 15 times free cash flow by, let's say, 2027, this is $300 per share, or 50% on the upside over the next 2.5 years. And it's not expensive at all. Right now, if they took the lower end of the range of the analyst estimates in terms of a free cash flow, it's trading around 18 times. So it's really not bad at all. I think 15 to 20 times free cash flow is cheap for the company, especially as Wall Street and the market wakes up to the trend and what's really happening in the world. I would expect 15 to 20 times. If we do hit 15 times, there's 50% on the upside by 2027. If we trade at 20 times, it would be up to 100% on the upside over the next 3 years with an amazing company with massive tailwinds. And worst case scenario, the free cash yield is 8% and it's expanding. So I would say 8 to 10%. So I mean, I don't see much downside with the stock. Yes, it could pull back a little bit because the stock is up. But whenever I look at that stuff, I normally start with a small position and then I dollar cost average down, because if the stock goes down, then I'm happy and I get to buy more. I don't just panic and, oh, my stock is down, I start crying like a lot of people do. I get happy when my stock goes down because I can look at the thesis. If the thesis is still the same, then I get to buy more, and even Cheniere Energy gets to buy back more stock, and then I get even more value as a long-term investor. So that's how I look at Cheniere Energy. I like it very much. Even though the stock is up, I still believe the stock is a buy. If you're interested in more of such long-term mega trends and other stuff, I do a lot of such investments in my own group and I share everything I do. This is the link if you're interested. But thank you very much for watching. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.